You've heard people talk about using their home as an ATM. But how does that actually work? We're diving into the HELOC, or home equity line of credit. This isn't just a loan, it's a financial tool that can fund major renovations, consolidate debt, or even start a new business. But it comes with big risks. Let's break down what a HELOC is, why it exists, and the crucial pros and cons you need to know. You've probably heard people say they use their house like an ATM. Here's what that actually means. A HELOC, home equity line of credit. It's not just a loan, it's a revolving line of credit secured by your home's equity. Think giant credit card, but the collateral is your house. Let's keep it simple. What is equity? Equity is simply the difference between the current market value of your home and the amount you still owe on your mortgage. Example, if your house is worth $500,000 and your mortgage balance is $200,000, your equity is $300,000. How it works. The bank approves you for a specific limit, usually up to 80% or 90% of your home's equity. Once approved, you can borrow, repay, and borrow again, just like a credit card, during the initial draw period. How it works. You get a limit, there's a draw period, usually 5 to 10 years, where you can borrow, repay, and borrow again. You only pay interest on what you actually use. After the draw period ends, you enter repayment, where you pay principal plus interest. We'll come back to that. Why does the HELOC exist? The HELOC exists because it offers a highly efficient way to borrow large amounts of cash using the lowest interest rates available, thanks to the collateral, your home. It's efficient, flexible cash for big moves. Let's see its various purposes. First purpose is major capital needs, something like renovations, which is the most common use. New kitchen, room addition, roof. You can increase the value of your home while funding the project cheaply. Another purpose can be to fund the education, funding college tuition, or other major educational expenses. Also, debt consolidation. Because HELOC rates are often far lower than credit card or personal loan rates, it can be used to pay off high-interest debt, simplifying your payments and saving thousands in interest. But only if you stop reloading the credit cards. And last, for something like emergency fund backstop. Some people open a HELOC purely as an accessible, low-cost line of credit that they only use in a true financial emergency. It's accessible capital if life punches you in the face. Now, the crucial pros and cons. Pros: lowest interest rates. Since your home is collateral, the interest rates are typically variable and significantly lower than any unsecured loan. Flexible access. Revolving credit. You only pay interest on the money you actually use, and you can access and repay funds repeatedly during the draw period. Interest-only payments, initially. During the initial draw period, often 5 to 10 years, you often only have to pay the interest accrued on the outstanding balance, keeping monthly payments very low. Tax deductibility, USA. In the US, the interest on a HELOC may be tax deductible if the funds are used to substantially build, buy, or improve the home. Check current tax laws. Cons. Pay attention here. Variable interest rate. Most HELOC rates are tied to the prime rate. If the prime rate goes up, your monthly interest payment will increase, sometimes substantially. Risk of foreclosure. This is the biggest risk. Because your home is the collateral, if you default on your HELOC payments, you could lose your house. The repayment shock. After the initial draw period ends, e.g. 10 years, the repayment period begins, e.g. 20 years. Your payments jump significantly because you must now pay back both the principal and the interest, leading to potential payment shock. Equity erosion. If housing values drop, the bank could potentially freeze or reduce your credit limit, even if you haven't used it, leaving you stranded if you needed the funds. A HELOC is a fantastic tool for debt consolidation or renovations, but you must respect the collateral. Use it only when the benefit, like a major home renovation, justifies the risk, and always plan for the payment shock when the draw period ends. Do your math, and never borrow more than you can comfortably afford to pay back, even if rates increase.